Morning, everybody, and welcome to another training session with yours truly, Ian Giffen, GoPro Trading Academy. And today we're going to be chatting about the difference between using indicators versus price action. A lot of people don't realize it, but both of them are really quite distinct forms of technical analysis. And although we do use indicators that help us with price action based information, as a rule, we need to be careful when it comes to the use of indicators. So why do I say that? Now, before we get into the different types that are useful, I just wanted to chat a little bit about the kind of philosophy, if you like, behind why one would do anything when looking at a chart. And as many of you already know, we are dealing with an environment that is characterized by extreme uncertainty. For all intents and purposes, it's basically random. Whereas the human condition includes this thing called the predictive mindset, as our Israeli researchers Danny Kahneman and Amos Tversky got the Nobel Prize for the research into how the human brain works. And it's absolutely essential to understand that that is really the number one weakness that we all have when it comes to trading. Obviously, it's a massive strength in many other areas, but when it comes to dealing with an environment that A, we cannot control, and B, where whatever patterns we identify on at best extremely unreliable, there is no real way to predict anything meaningful in the markets. Now, I grant you that we are going to naturally resist that notion. I'm sure right now, as I say that, you probably feel a desire to reject that. And that's normal. That is actually just proof, though, that your brain is a predictive engine. So it's not saying anything about the truth of the matter. It's saying a lot about how your mind works and my mind works. So recognize that. Now, what our tendency, therefore, drives us to do with this predictive mindset is to look to find ways where we potentially could predict something. And coming back to indicators now, most people who use indicators for trading, or certainly people who come into trading, aspiring traders, most of them look at a combination of indicators or are searching for a combination of indicators that will allow them to get into the market at the right time and get out at the right time. And I'm sure that basic statement resonates very strongly with you. That's normal. Most people, when they start out with trading, and when I think back to the early days of my trading as well, when I actually started doing technical analysis, I was the same. We are all like that. If you look at fundamentals as well, fundamental traders, well, what are they doing? They're looking to identify opportunities that are not yet priced into the market based on fundamental data. And using that fundamental data, they then determine for themselves whether a security is going to go up or down, and they will act accordingly. And it's still looking for a way to predict the future in an environment that's fundamentally uncertain. So bear that in mind when you yourself are looking to identify chart patterns or identify a strategy using a set of indicators, where the RSI is above this and your one moving average is below the other. These are things that people do. It's natural and normal for us to look to find a combination of indicators that will help us to determine when is the right time to get in and when is the right time to get out. All right, so that's just basic overview. Before I do carry on, please feel free to ask me any questions in the chat box. And if you're watching this as a recording, you're welcome to ask questions in the comments below. All right, so let's talk about indicators for a second then. Why is it that they are of such limited use to us? And I will come back and describe some indicators that are useful as well. And one of them is on the screen right now, right at the bottom, the average true range. But what is it about indicators that gives us such a desire to use them, first of all, and secondly, why they can't help us with that. The main reason they can't help us is because all indicators are basically taking a certain amount of historical data, putting it through some kind of a formula and spitting out a new number over time. You know, that's how all indicators work. It's just a formula that's different, nothing else. But clearly, the indicators are using historical data. And that historical data cannot really help you to identify what's going to happen in the future. This is another one of our biases, is called the cognitive biases, is called the narrative effect. We like to, in fact, instinctively, we look at things that happened in the past, we join the dots, and we try to extrapolate that sequence of dots into the future. And that only works when you've got either a natural, reliable, repeating pattern, like the sun coming up and going down, or if you have control over the environment. Otherwise, it doesn't help. And unfortunately, in trading, that narrative effect of ours is also very strong. We look at what's happened in the past and say, "Oh, great! If it happened that way in the past, then next time I see that pattern or that combination of indicators doing the same thing, then I can predict that the outcome will be the same." And most of you here have been trading for quite some time. You know that it doesn't work very well. So that's the main reason indicators are actually quite useless as a rule, is because what happened in the past and some rehashing of that through some black box type of formula isn't going to tell you anything about the behavior of market participants in the future, particularly as they respond to events unfolding that were completely different from what happened in the past. Because ultimately, that is what drives market price. It's the consensus or lack of consensus amongst market participants about what is cheap or expensive based on current, not just events, although that obviously is important, including the fundamentals, but also in terms of the combined biases, cognitive biases of those market participants. And that, of course, is where price action comes in. So what price action does not do is take historical data and rehash it. What it does is it recognizes that market participants react to certain things. And again, these cognitive biases come to the fore. And a very important one, which reflects the first of two elements of price action, is support and resistance. Support and resistance is, in fact, a consequence of the cognitive bias amongst market participants called anchoring. We anchor our perception of what is cheap and expensive to what's happened in the past. And when you combine that with the recency effect, the more recent past has a more significant impact on that anchoring effect than things that happened further back in the past. So that's why, as an example, why we like to use price action. Likewise, if a support or resistance level is broken, what that allows us to determine, and again, all of this is with a probabilistic mindset, but what we're able to start thinking about if a level has been broken is the disposition effect coming to the fore. So although when support and resistance is respected, that's the anchoring effect. When it's broken, it's the disposition effect. And what the disposition effect really is the tendency of humans to throw good money after bad. We are all like that. It's also called the sunk cost effect. So without boring you too much about all these cognitive biases, because you don't really need to know all of these details, I'm just explaining to you why we do what we do. We've taken these cognitive biases and we, instead of worrying about what they are, we look to see what effect they have on the charts. And again, this is not about prediction. You have to apply a probabilistic mindset to this. but having said that, it does help us identify patterns that do have I don't want to say a higher probability of working out, because that's a predictive statement, but it allows us to apply strategies that have an edge. That's the best way of putting it. And of course, those of us who understand convexity, we also look to apply an edge that offers convexity as well, which is the principle of limiting downside and maximizing upside. So for those of you who've done my training, we've got those 3 pillars that support every aspect of our trading and actually allow us to dominate in this environment that's so characterized by uncertainty. Well, the first pillar is having an edge. But that edge ultimately, especially for a core strategy, needs to be a convex edge, always limiting downside, maximizing upside. And then you combine that with the third pillar, which is the law of large numbers, never risking more than 1% per trade. And over time, that edge shows itself, it works itself out by giving us a positive expectancy at low risk. So that's how we make money from trading. And what price action allows us to do is to find these edges and to be able to apply them. So it's not about predicting what's going to happen in any one instance ever, not ever. But I mean, when we see the price come down to a support level, for instance, as an example, the one thing we can't say is that because it's a support level, the market's going to bounce off of that level. Even if it does break through, if the market breaks through support level, does that mean that it's going to carry on going? Can we predict that it's going to carry on going? Well, no, we can't either. What we even could say is more often than not, when the market breaks through a support or resistance level, it's a false breakout. So it'll just show us a new support or resistance level. It'll redefine our boundaries for our range. But more often than not, that breakout is actually not successful. So why on earth would we trade it? Well, because when it is successful, the market goes, the potential for gain is much greater than the risk that you need to take. And that again represents a convex optionality curve. So that's the power behind using price action, because at least it does give us valuable information that we can use when combined with our probabilistic mindset to apply a convex edge. Whereas coming back to indicators, unfortunately, indicators, as I say, don't really give us any indication as to what the market participants or the combination of these cognitive biases of the market participants is going to do at all. Having said that, though, there are some exceptions to that. It still comes back to the fact that market participants are observing these. One example is what I find is the 55 exponential moving average. So let me actually add it here. And particularly in a trending market, the exponential moving average, 55 EMA, I should say, has proven to be an interesting support, dynamic support, and resistance level. So let's just go find that here. Say, oops, 55. We want exponential on close. We'll keep it as red. Let's just make it a little thicker so that you can see it. Right, so this obviously being on a, this is the weekly time frame over here. So let's just pop down to a daily. Now, again, this is not ever supposed to be predictive in nature, but you will find over and over again that the market does come back to this as a support or resistance level and respect it. We actually had a strategy many years ago. For those of you who've been on my training 7-8 years ago, you'll remember that we did have a strategy based on this. It still works. It's just not as good an edge as our other ones. So in any event, you can see how this did offer support until it was broken. Didn't do much after that, broke back above it, bounced off of it almost exactly again. So just reiterate that once again, this is not meant to be predictive. Let me just make this a bit smaller. There we go. In nature, but it is something that can be useful. Another indicator that you guys have heard me talk about is the the Donchian channel indicator. Now, the Donchian channel indicator, which you can download, and for those of you interested, those of you members, I can make that available to you as well. But you can actually just download it from the MQL5 website. Is not, in fact, just an indicator. As you know already, Donchian channels are an indication of support and resistance levels. And of course, that is price action. So likewise with this, with a 55 EMA, we are interested in this as a potential support or resistance level. It's dynamic in this case, certainly, but that's what we would be interested in it for, not the fact that it's actually an indicator. So why does it have any value as a result? Well, because the market seems to look at the 50 to 55 exponential moving average. And again, they anchor their perception of what is cheap or expensive to that level. So it's still the same thing. Another support resistance level that's dynamic, of course, would be a trend line. Now, the problem with trend lines is if you've got 10 traders, you'll have 10 different trend lines for the same trend. But it is also a support or resistance level that can be useful. But again, that is a price action phenomenon and not actually an indicator. Coming to our ATR that we have at the bottom over here, so many of you will be familiar with this as well. The average true range is, of course, an indicator, but it's more than that. In fact, it's a calculation that tells us the average candle size. So the difference between the high and the low of a candle is the candle size. If you're looking at the last 21 candles and you want to know what the average candle size is, well, that's what the ATR will give you. You've just got to make sure that it's set to the correct setting. So this is obviously on a 30. You guys will know that when it comes to the daily time frame, I like to use a 21-day ATR. And the reason for that is because it's a rolling month. There are approximately 21 trading days on average per month throughout the year. It's also a Fibonacci number. So the ATR is useful because it allows us to compare different instruments in terms of their recent volatility. Likewise, we can also see the change of volatility in an individual instrument over time. And you will see very clearly here how on this time frame, on the daily time frame, and even though it's a 30, you'll see it's still relatively accurate, but I'll change it in any case just to be consistent with what I'm saying to you. You can see how the volatility was quite extreme. And I'm sure you'll recognize what that's from. Let me just get some of these things off of my screen so I can see what I'm doing. If we go back to this period here, this of course was the time when the whole COVID news broke in that very volatile period early in 2020, and that's why you can see the volatility for this instrument and across the board, of course, spiking up to relatively high levels. In fact, let's just see what the peak was over here. This is the Euro USD. It's always a good benchmark. It didn't quite make 200. There we go, 181. If you go further back in time, even 2008, I remember it was very, very high, also extremely high volatility levels. Now, this is useful in a number of ways, and those of you who are trading our strategies and have been on my training will know many of the ways that we use the ATR. But it's really, really important to be able to compare one single instrument or currency pair over time and see how that's changing, because the lower the volatility, the harder it is to make money. I remember going back to 2014, how the ATR for the euro dropped to 38 pips. It dropped very low again in the run up to all of that volatility that we had with COVID. Let's have a look at this. There you go, 39 pips in late 2019. It was a period where it was quite difficult to be profitable in our trading. Whereas much as the COVID thing is an awful nuisance and very bad, and that it's taking lives, it has to also be said that as traders, anything that causes volatility helps us to be profitable. And it was an extremely profitable period for us in the early part of 2020 as a result of that. So um, one of the rules we have in one of our strategies as well is that when the ATR drops below a certain percentage of the longer term average, we actually stop trading that strategy, simply because the volatility isn't allowing us to make money on that instrument. So it's useful for that as well. So there we have an example of an indicator that, again, however, is not really a typical indicator. It's simply a calculation that's giving us information about price action. And that price action is, well, the high of a candle is the intraday resistance level, and the low of a candle is the intraday support level. And the difference between the two would obviously encompass the cyclicity that took place during the course of that day, assuming we're looking at a daily time frame. And both of those, cyclicity and support and resistance, are the two elements of price action. So this is an indication rather than an indicator, if you like, and that's why it's useful. So you can see that even where we do use indicators, we're using them to give us price-based data or price action-based data that allows us to increase the power of our edges and our strategies. So in a nutshell then, just to summarize everything I've been saying, is we have these two quite distinct categories of technical analysis. The one being traditional technical analysis, which focuses exclusively on indicators. And then we have price action, which is a very different way of looking at the market. I personally think that as long as you have a convex edge, it doesn't really matter which you use. The absolute key is having that convex edge and being able to apply it consistently over time, which requires you to have that probabilistic mindset. That's much more important. However, I personally have found that price action offers us those convex edges a lot more reliably than indicator-based technical analysis does. And that's why I use it. So if there was a better way of doing it, I'd be teaching you that. So make sure that whatever method you use, you have your core strategy certainly would need to be offering you convexity in the way it's applied. The challenge with a convex strategy is that very often they are more difficult from a psychological point of view to apply. That's why they are professional strategies. They're not technically more complicated. They are just more difficult to apply because we naturally want to know what's going to happen next. We are always going to prefer to trade a strategy where we can have confidence that the next trade is going to win. Unfortunately, that is the opposite of convexity and is what causes most profitable traders ultimately to lose all their money. So we prefer, obviously, to focus on price action. It is also using the most recent information. It's not some aggregation of a random number of previous candles. So a 21 EMA or even the 55 EMA, that's what makes those numbers special. Why not 22 or 26? So it's interesting how people come up with these, but unless there are a lot of people in the market observing that same thing, in other words, it's going to affect the behavior of the majority of market participants, it's not going to help you at all. And if it does affect the majority of market participants, then certainly. But then you're coming back to why we use price action, because that gives us the most reliable way of identifying the aggregate behavior of market participants and seeing the effect of their cognitive biases playing out. And we build all of our strategies around that. All right, so that for me is the main difference between indicators and price action. There is a bit of an overlap, I agree, where we have indicators that help us with price action and analysis. But again, it comes back to that price action analysis. All right, folks, I don't see any questions popping up into the chat box, but I hope that that's useful for you. If you're not familiar with our price action strategies, we have a professional strategy, 3 videos of training on that, going into it in quite a lot of depth, available on our website. So please make sure that you get into that training if you haven't done it before. But if you're familiar with our stuff, then I'm sure you'll agree with me that using price action as a basis for developing strategies that give us convexity, as well as helping us to determine where we are at in the life cycle of a market, so that we can only apply our strategies to the appropriate market conditions. There's nothing to beat it. Indicators aren't going to give you much of an indication whether we are in trending or ranging conditions, let alone a strong or a weak trend. Whereas price action absolutely does give us very definitive answers to those questions. As I'm sure you guys know already, it gives us enough clarity in areas that allow us to move on to using our probabilistic mindset. Right, still no questions, folks. That's it as far as this discussion is concerned with indicators versus price action. Remember, if you do think of any questions, you're welcome to pop it into the comments below. Guys, enjoy the rest of the week's trading. I will see those of you who are members of the Academy tomorrow, and otherwise we will be having our Monday morning market review as always, and I'll see you guys then. Bye for now.